afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, just a quick reminder that everyone that is registered for today's program will receive a copy by the end of this week. Today, we're excited to welcome back Erin Kerrigan, founder and managing director of Kerrigan Advisors. Erin, I've previewed your deck, and I know you have a lot to fill us in on, so I'm going to let you take it away.
Thank you, Rachel, and thank you, AIADA, for inviting Kerrigan Advisors to discuss today's white-hot active buy-sell market and the drivers of today's record valuations. Before I get started, for those who aren't familiar with Kerrigan Advisors, we are the publisher of the Blue Sky Report, which we just published last week for the second quarter. If you don't get a copy, please let me know. I'm happy to include you. And that report is informed by the client service work that we do with dealers nationwide. We're probably best known for our sell side services, where we work with some of the larger dealers and dealership groups that are looking to sell their business. In this part of our practice, we attribute our firm's success to our team's laser focus on fulfilling our clients' personal and financial goals with each transaction. And we do not take listings, rather we work on a select number of deals. The ones you see we announce are the ones that we have been engaged on. We also raise capital for dealers and have a consulting practice where we work on an hourly basis to assist buyers with their strategic growth and capital planning. You can see that we've been very busy on transactions nationwide in the last 12 months, raising well over $1 billion on behalf of our clients, many of whom, of course, are AIADA members. Okay, with that little overview, I thought we would jump into the meat of the presentation today, and it'd be only appropriate to employ a college football theme to today's webinar. After all, many of us are very excited to once again enjoy our favorite sports teams, along with cheering fans. I have just returned from Notre Dame Stadium last weekend, and I can certainly share with you that there are similarities between the jubilance of the Irish fans and the excitement around the buy-sell market. Like the strong desire many of us have for live sports entertainment, there is tremendous desire by many to acquire dealerships today, and that demand is translating to a dynamic buy-sell market, which today is tracking to hit another record. Kerrigan Advisors expects 2021 will surpass 2020's high with over 350 buy-sells by the end of the year. We noted in our first quarter report that many sellers are laser focused on closing their transaction before the end of this year due to the threat of an increase in capital gains tax. So we expect the second half of 2021 to surpass the deal activity we saw in the first half. Of course, it will come of no surprise to anyone on the line today that the primary driver of today's tremendous buy-sell activity is our industry's explosive profitability. In the first half of 2021, the average dealership earned a jaw-dropping $1.96 million, up 164% from pre-COVID averages, and remarkably more than any prior year's earnings before COVID, meaning the first half is more than we ever earned in a full year before COVID. Our industry has simply defied all odds and proven to everyone its resilience and the nimble nature of our business model, despite the most challenging of circumstances. One of the primary drivers of auto retail's stellar performance is the limited supply of vehicles resulting from the semiconductor chip shortage. The resurgence recently of COVID cases globally is certainly exacerbating this setback, causing cascading disruptions throughout the entire auto industry's supply chain. Through June, the estimated days supply of new vehicles reached a record low of just 29 vehicles. Limited supply, of course, coupled with strong consumer demand that everyone on the line is experiencing, is resulting in record prices for both new and used vehicles. And that, of course, is then leading to very high grosses on both new and used vehicles as well. Year to date through June, average new vehicle gross profits more than doubled compared to 2019 pre-pandemic levels, while used vehicle grosses rose an impressive 79%. Now, with no end in sight to the industry's supply constraints, higher gross profits are expected to be a fixture of the industry into next year and potentially even longer. As I said in our first quarter Blue Sky report, if it takes 60 days to create a habit, our industry has been operating with limited inventory for well over a year, potentially making low inventory levels and higher grosses the new normal. More and more OEMs are announcing plans to reduce their days supply of inventory even after chip availability rebounds, as many have experienced the economic benefits of undersupplying the market, including lower incentive spending and higher corporate profits. But OEMs are not alone in their desire to operate with leaner inventories. Dealers today are witnessing the economic advantages of a more productive and efficient business model, including achieving much lower SG&A costs, as you can see here, as a percentage of gross profit, and discovering fewer employees can produce higher profits when they are more productive. Much of these productivity gains are expected to last long after inventories rebound. And many dealers have no plans, according to our conversations, to return to the low margin business from which we came. While 5% net to sales that we're achieving today may be difficult to sustain in the future, the industry is definitely not planning to return to the pre-pandemic average of just 2.5%. Today's auto retail business model is simply better and one that most would like to see stick post-COVID. So with that backdrop on the industry, I'd like to discuss some key trends in the buy-sell market, starting with the buyers. Given the industry's incredible profit performance over the last 12 months and positive outlook for 2022 and beyond, Kerrigan Advisors finds most dealers today are buyers, not sellers. With the drumbeat of consolidation getting ever louder, dealers increasingly believe size will determine their future success. Many are focused on expanding their regional market share and diversifying their franchise mix. Few believe the steady state will suffice to succeed in a changing auto retail environment. COVID-19 further highlighted the growing importance of scale, with the largest groups achieving outsized profits relative to smaller groups and single-point dealers. Not surprisingly, we see the number of dealers with 5 or fewer stores continue to decline as they exit, while those with 11 or more has increased 82% since 2010. And more dealers feel they need to either commit to a growth strategy or consider an exit. Inertia is not an option. The good news today is dealers have more than enough capital to execute on their growth plans, particularly from the debt markets. The average dealer's debt to equity ratio is approaching just 1.06, a significant decline from 2019's ratio, meaning there is excess debt capacity within our industry. Today, dealers not only have a historic amount of cash in their bank accounts because, of course, of their record profitability, they also have increasing access to acquisition leverage at historically low borrowing rates and attractive terms. Many find themselves in the strongest financial position they have been in their careers and are better able to consider meaningful expansion and large multi-dealership acquisitions. As a result, Kerrigan Advisors sees a growing pool of dealers who are anxious to put their capital to work and acquire multiple dealerships and dealership groups, resulting in a number of multi-dealership transactions in the first half of 2021, more than we've ever seen. 51, up 93% from pre-COVID levels. And just to give you a sense, that's 35% of the transactions completed in the first half were multi-dealership transactions. While there have always been buyers for dominant dealerships in growing markets, what we find is the buyer pool for smaller and medium-sized dealership groups pre-COVID was often quite thin, particularly if a major consolidator was uninterested. Today, however, the pool of buyers for most dealerships and dealership groups is abundant, as many dealers are financially confident in deploying considerable amounts of capital towards major expansion. In addition to the growing pool of private buyers seeking acquisitions, the publics have also meaningfully jumped back into the expansion mode, acquiring 61 franchises in the first half of 2021, more than they did all of last year and certainly all of 2019, as you can see in this chart. They also only sold 12 franchises in the first half of this year. In fact, as you can see on this graph, they had in 2020, they reverted from being net sellers of dealerships because they sold 40 in 19 and only bought 19 stores in 19. Now they're buying much more than they are selling. Since Wall Street is paying a price premium for companies that grow through acquisitions, it is not surprising to see more publics enter the acquisition market this year. Whereas last year, only Lithia and Asbury accounted for the U.S. dealership acquisitions by the publics. Year to date, Penske, Group 1, and Sonic have also completed acquisitions. And of course, Group 1 just announced a major acquisition that they expect to complete by the end of the year in the Prime acquisition. This is a reversal from where these companies were in the last few years. The public dealership groups are benefiting from a continued rise in their stock price, as Wall Street investors also experience outsized returns from their investments in auto retail. Since the lows that we saw in March of 2020, the Kerrigan Index, which is made up of the 7 publicly traded auto retailers, has risen an impressive 256%. Now, with the public stock prices on the rise, more acquisitions are accretive to these companies' earnings, and thus they are allocating more capital to U.S. dealership acquisitions. In fact, through the first half of 21, the publics more than doubled their allocation to U.S. dealership acquisitions to 53% from 20% in the first half of 2020. And in the last 4 quarters alone, they have spent a record $4.45 billion acquiring dealerships. Just in the first half of this year, they've spent $2.1 billion. So really remarkable amount of spending that the publics have made. And again, this is from many years of only spending about $700 million. Interestingly to us, the industry's financial success has also made it even harder for outside capital to find attractive dealership investments, given tremendous competition from both public and private dealers. Existing dealers today have little need for an outside capital partner to fund their growth. They have plenty of money on their own and great lender relationships. As a result, we expect outside capital will receive the quote-unquote Heisman treatment from our industry over the next 12 months, as these investors find the intense buyer competition from existing dealers makes it quite challenging to enter our market. Okay, now that we have discussed the buyer trends, let's turn to the sellers, many of whom see a window of opportunity to score big with a massive exit. Like the new vehicle market, demand for dealerships is far exceeding supply, creating a seller's market for most franchises, particularly those in high growth markets. With more buyers seeking acquisitions from a limited supply of sellers, the rising tide of industry performance is lifting most boats, resulting in record valuations for many franchises. When we include the average real estate values, the average dealership enterprise value is approaching $21 million, a 19% increase over 2019. For multi-dealership transactions, most of which include at least 3 dealerships, you're looking at an average transaction size of over $60 million in proceeds. Now, as I mentioned earlier, the pool of buyers for transactions of that kind of size, 20 million or more, before the pandemic was pretty small. Dealers today who are considering a sale, I think they realize that, and they realize that their valuations, since they are so big, are much more sensitive to the financial markets and the economy. Many want to make sure to capitalize on today's high values while buyers are flush with cash and have great access to acquisition financing. Now, one of the reasons that we are seeing more dealers come to market besides valuation is the risk associated with this industry disruption and OEM's future plans for the business model. Whether that is attempts to go direct to consumers, create a build to order system, or change the retail model completely by compensating dealers with a set delivery fee for selling vehicles instead of enabling dealers to negotiate margin. As a reminder, our industry's ability to succeed despite low volumes in the last few years has been driven by our pricing power. If taken away, as Volvo and others have suggested, by simply paying dealers a flat fee for each sale, the nimble nature of our business model would be significantly curtailed, as would our ability to adjust to markets and remain highly profitable by flexing our pricing power. These suggested business model changes that seem to be whiteboarded daily by the OEMs are particularly concerning when considering the real estate demands that OEMs continue to make. It seems to us that dealers' largest single investment, their real estate, is not even reaching the OEM's whiteboard as they plan for electrification and a digital future. Perhaps they have forgotten that you all have very large mortgages that need to be paid to support these large facility investments as they continue to adapt in this industry. The best example of this challenge, of course, is Jaguar, which puts its facility plans suddenly on hold over the last few months as they announced rather abruptly their all-electric fleet plans, despite the fact that many dealers were either completing a new facility or having completed their new facility. And this facility that was required was one of the most expensive image facilities in the industry. If OEMs do not adjust dealership real estate requirements to reflect a changing auto retail environment that they like to talk about all the time, Kerrigan Advisors believes real estate investments will become one of the more divisive issues between OEMs and dealers and will ultimately drive more dealers to sell. The final seller trend that I'd like to discuss is valuation. In the midst of most sellers, in the minds of most sellers, they have transformed their business and do not believe their dealerships will fully return to the low margin earnings of the pre-pandemic era. With each passing month of record profits, and as the pre-pandemic period seems more and more like ancient history, fewer sellers are willing to price their blue sky without recognition, at least, of their improved profit outlook. Quite frankly, yesterday's valuations seem ludicrous relative to today's high earnings. As a result, we are seeing that sellers are becoming less flexible with their asking prices and more determined to achieve a valuation that takes into account some of 2021's improved profits. Sellers are also increasingly aware that their current return on equity from their dealerships, which is estimated at over 57% as of the end of June 2021, will be very hard to replicate in today's low-yield investment environment. Few investments provide the level of return afforded dealers, which makes it harder for them to accept anything but their asking price. With this in mind, let's wrap up this webinar with a review of our blue sky multiples. Now, valuation of blue sky is a challenging exercise in most markets, but particularly in 2021, as I highlighted it on that previous trend, because both buyers and sellers are struggling with what to apply a blue sky multiple to. Kerrigan Advisors finds that most deals are ultimately getting done based on a valuation that averages pre-pandemic and post-quarantine earnings, meaning that most of the multiples are being applied to 2009, an average of 2019 earnings and TTM, trailing 12 months, 2021 earnings. Less focus is on 2020 earnings because of the quarantine period and the disruptions of 2020. So we are seeing that most deals are getting done based on that kind of valuation, applying the multiples to the average of 19 and most recent trailing 12 months earnings. In doing it this way, buyers are effectively hedging their bets, equally recognizing today's improved performance while considering the potential for earnings to return to some level of pre-pandemic profits. Kerrigan Advisors does caution buyers who are overly conservative in their 2021 valuations, as we expect prices to rise further in 2022. As we get further away from 2019's earnings, they become less and less relevant, and dealerships that seem expensive this year may well have an even higher purchase price next year. With that intro in mind, let's discuss specific franchise multiples. For the second quarter of 21, in our most recent report, which we published again last week, Kerrigan Advisors made no adjustments to our blue sky multiples. The industry's tremendous profit performance is resulting in stronger blue sky values for most franchises. While the future of inventory availability does remain uncertain, we find that most dealers are thriving in a low supply, high demand market. In this environment, most franchises are trading on the higher end of our multiple ranges when applying them to average of pre-pandemic and trailing 12 months earnings. As I said earlier, the rising tide of industry profits is definitely having the effect of lifting all franchise boats. Now, overall, we saw more import transactions than domestics in the first half, resulting in a disproportionate buy-sell market share for imports. You can see that 58% of the buy-sell market was import franchises, while only 34% of franchises in the US are import. We find that during peak periods of profitability, buyer demand for import franchises rises as these franchises tend to outperform a very strong market. Also, many imports were better positioned with greater inventory availability in the first half and fewer supply constraints in the first half of 2021. Now, while Kerrigan Advisors did not adjust our blue sky multiples this quarter, we did make changes to our franchise outlook for certain franchises due to fluctuations in buyer demand. And specifically, we made outlook changes to the non-luxury franchises: Chrysler, Dodge, Jeep, Ram, Nissan, and Ford. We increased the outlook for CDJR and Nissan, and we decreased the outlook for Ford. And I'll talk about that in more detail. As you see here, this is the analytics that we do each quarter. We find that buyer demand for Chrysler franchises is on the rise as these franchises have done very well, resulting in impressive sales gains of 32% in the first half of 2021 with more inventory availability. Also, Stellantis's recent announcement regarding the acquisition of First Investors Financial Services Group may provide the company with higher blue sky multiples because they'll have a supportive captive finance company, which we find is a very important part of the success of many franchises. You'll see that we increase CDJR from steady to positive outlook for that franchise multiple. We also increased Nissan's multiple outlook from steady to positive, as we are finding the Nissan franchises are seeing dramatic improvement in sales and profitability, and there is more buyer demand for these franchises, particularly in high growth markets like Florida and Texas. We recently sold a successful Nissan store in Florida to the Morgan Automotive Group and found there was tremendous buyer demand for that franchise. We have unfortunately downgraded Ford's multiple outlook from steady to negative. We do find that Ford is having much more challenges as it relates to inventories, and that there is less buyer demand today for Ford franchises than there was prior to this quarter. And that is something that we'll continue to monitor, and that may result in a reduction in Ford's multiple in the future. As it relates to luxury franchises, we made no changes here as well, though I will share that multiples for the top luxury franchises, such as Porsche, Mercedes, Lexus, BMW, are tending to be at the very highest end of this range, and in some cases even higher in the high growth markets, which is pretty incredible. And frankly, we're seeing these franchises trade as high as we've ever seen in our careers. In terms of the analysis of these franchises on the next page, you'll see that what we find is the reason the top luxury franchises do so well is that they have a superior business model with lower dealer counts, which drives sales per franchise higher and results in a very strong and highly profitable fixed operations, making top luxury franchises attractive investments even in an evolving retail environment. In fact, with higher facility costs, even though they have these higher facility costs, most of these top luxury franchises do have the highest fixed absorption in the industry, which is a testament to the fact that they have a higher UIO count per dealership. I want to share with you two additional themes that we're continuing to track at Kerrigan Advisors and that you may see in these charts going forward. One is we're tracking all these announcements regarding electrification and the potential changes to the business model as I touched upon earlier. That is something that we do think will have an effect on valuation going forward, depending on which way OEMs go. So we will continue to analyze that and weigh that as it relates to the valuation of each of these franchises. We are also tracking the buy-sell approval process, and we are doing that because with the volume of buy-sells that we are seeing today on such a rise, we are seeing some OEMs react more efficiently and run these processes more efficiently than others. And as with any investment, the more liquid an investment, the higher the value of an investment. If OEMs are slow or cumbersome in their approval process, that reduces the liquidity process for a seller and can have the effect of reducing a blue sky multiple. We noted in our most recent report that General Motors in particular has had a very cumbersome process, and that is becoming somewhat of a challenge in the buy-sell, in getting buy-sells approved and to close. In closing, the buy-sell field will continue to be an active one in 2021, and we believe the froth, as Earl Hesselberg called it in his earnings call, will last well into 2022, with transactions continuing to rush the field and frankly overwhelm Team OEM a bit. We expect deal activity to be as exciting as this year's college football season, with more participation and engagement than we have seen in our industry's history. To quote the legendary Notre Dame football coach Lou Holtz, "Life is 10% what happens to you and 90% how you respond to it." I'm quite confident dealers will continue to respond to the changes and challenges of the auto retail market and succeed no matter what the OEMs throw at you. Thank you for your time. Please do not hesitate to reach out if you have any questions about this presentation or would like to have a confidential conversation about the buy-sell market. Thank you very much.
Erin, thanks so much for speaking with us today. There's a lot of great information here, and I always look forward to your decks and their themes. Again, everyone on the line, you will be receiving a copy of this webinar by the end of this week. Join us back here on Tuesday, October 5th at 2 p.m. Eastern as Dell Technologies discusses how artificial intelligence is changing the automotive landscape. For more information about AIADA, visit aiada.org. Thanks for joining us and have a great day, everyone.